Hello class, this is a video lecture of chapter 6 of the personal finance text. And in this chapter we'll be covering taxes and tax planning. The US tax code is based on the idea that everyone should help finance the government according to ability to pay. So in this chapter we're going to get a little bit more political. Changes in how everyone is defined and how ability to pay is measured have led to tax law changes that keep the system evolving. The learning objectives of this chapter is to identify the levels of government that impose taxes, define the different kinds of incomes, assets, transactions that may be taxed, compare and contrast progressive and regressive taxes. In the United States, tax laws are written by Congress and therefore through compromise. As views on government financing have changed, tax laws have been amended and refined, enacted and repealed. The result is a tax code that can seem overly complex and even unreasonable or illogical. And the last time I checked, I believe the tax code was about 14,000 pages long, which is as long as it's ever been. You can double check that, but just to give you an idea of how complicated it is. However, the system is based on logic and has a purpose. There's a couple different kinds of taxes um, and ways that we're taxed. So we have a progressive tax. As income increases, tax increases. So I would imagine that the opposite of this is a flat tax, which we don't have that in this country. There's some other countries that do have a flat tax, like Estonia and other post-Soviet countries that have a flat tax, but we have a progressive tax. So the more the more money you make, generally, the higher your tax. In a regressive tax, as your income increases, your tax decreases. So, as you've heard people saying that those in the top 1% or corporations and whatnot are not taxed, this is what regressive tax means. So it kind of feels like we have a little bit of both. Taxation and kinds of taxes. So the income tax is contingent upon wages, interest, dividends, gains, rents, loyalties, and self-employment. And it's levied by the national, state, and local governments. Sales or consumption tax is contingent upon consumer goods and services, and this one is not contingent upon national but state and local government. Value added tax, you'll see this if any of you travel to Europe, you'll see what's called a VAT, and that's contingent upon goods and services tax at each stage of production. And generally, like if you go to Italy, for example, you'll only pay a VAT if it's a brand new product. But if it's not a new product, if it's like a second-hand product, you won't pay a VAT. Um, and it's contingent upon national and provincial governments that are outside the US. Excise tax are on specific items, and those are contingent upon national, state, and local governments. Property taxes, which is contingent upon residential or commercial real estate and vehicles, contingent upon state and local governments, but not national governments. And estate tax is contingent upon transfer of wealth, national and state, not local government. Some of the key takeaways here are that the government at all levels use taxes as a source of financing. And generally, my hypothesis is that the bigger the government, the more they require taxes. Taxes may be imposed on incomes from wages and interest, dividends and gains, losses, and rental of real or intellectual property. consumption of discretionary and non-discretionary goods and services, and wealth from asset ownership and asset transfer after death. Taxes could be progressive, such as the income tax, in which you pay proportionally more taxes the more income you have, or regressive taxes, such as a sales tax, in which we have to pay proportionally more taxes the less income you have. Some of the learning objectives of this next section, the U.S. income tax process, is to identify the taxes most relevant for personal financial planning, identify taxable incomes and the schedules used to report them, schedules or forms, calculate deductions, exemptions, and credits, compare methods of tax payment. So this is the U.S. federal income tax process. You have taxable entities, which are the individuals, corporations, nonprofit corporations, or trusts. An individual can either be single married, married, filing separately, or head of households, and each one of them matters and does impact whether or not you owe or the amount of credit you're going to get, depending on your income. Your adjusted gross income minus deductions, exemptions, and credit is the taxable income. Now we get more complicated. What is adjusted gross income? If you have wages or salary, you get a form at the end of W-2. If you get interest or dividends on stock that you own, that's a Schedule B. If you have business income, that's a Schedule C. Self-employment tax, Schedule SE. Capital gains on investments, that's a Schedule D. Rents and royalties, that's a Schedule E. Farm income, that's a Schedule F. Adjusted gross income minus deductions, exemptions, credits equals taxable income. I think this is the same as the previous slide we saw. Taxes paid during the tax year are withheld from wages, federal income, and you'll see on pay stubs. If you get a pay stub every 2 weeks, you'll see federal income taken out, state income. Florida does not have state income, I believe, but you'll see federal income, and you'll see the Social Security and Medicare taken out. And other taxes that are paid throughout the year are estimated and paid quarterly. Income tax less than taxes paid equals a refund. So this is when you hear of you getting money back at the end of the year. Income taxes more than taxes paid, you either have to pay, you get a penalty, or there's interest on you. And taxes is no joke. If you remember the gangster from back in the day, Al Capone, he was never arrested and put in jail for all those people that he killed. He was put in jail because of not paying taxes. So keep that in mind. Some key takeaways from this section. The most relevant tax for financial planning is the income tax, as it affects the taxpayer over an entire lifetime. Different kinds of income must be defined and declared on specific income schedules and are subject to tax. Deductions and exemptions reduce taxable income. Credits reduce tax obligations. Payments are made throughout the tax year through withholding from wages or through quarterly payments. Record keeping. Learning objectives. Identify sources of tax information. Explain the importance of verifiable records and record keeping. Compare sources of tax preparation assistance and trace the tax review process and its implications. The system for filing tax information has purposeful redundancies. Where possible, information is collected independently from at least two sources so it can be verified. So here we go. Record keeping, preparation, and filing. Information, wages, reported by you, the individual, on the Form 1040, reported by the employer on the Form W-2. Right? So what does this mean? The employer You fill out all the paperwork that you need to with your employer, and then they produce the tax forms, right? If dividends and interest is reported by the individual on the form 1040 Schedule B, reported by the payer on form 1099. And then if you'll notice, all the rest of these forms are 1099. Capital gains are reported by the individual on Schedule D, 1040, reported by the broker on form 1089. So this is the person that sends you the form that you need to file the taxes, okay? Retirement income reported by the individual on form 1040, reported by the trustee on form 1089. So even when you retire, they don't leave you alone. Consultant income reported by the individual on form 1040 Schedule C, reported by the client on form 1099. Incomes may be summarized and reported to you, but only you know your expenses. Expenditures are important if they are allowed as deductions, such as charitable gifts, medical and dental expenses, job related expenses, and so on. So, data should be collected throughout the tax year. Preparation, paid by prepare or do it yourself. If you do it yourself, you got software, and you can also, the software basically fills out the forms for you. So, like if you use TurboTax or something like that, that's what it does. It fills out the forms for you, and it asks you the questions and gives you the final report towards the end. Filing is either paid by prepare or do it yourself. If you do it yourself, you can e-file or you mail. Most of it is e-file now. We don't really mail things anymore. Tax strategies. Tax evasion is illegal. Tax avoidance, though, is legal. Timing and definition are what gets into play there. Tax code information is available from the IRS. Verifiable records must be kept for all taxable incomes and expenses or other taxable events and activities. Professional tax assistance and tax preparation software are readily available. The IRS reviews tax records for errors and may follow up through an informal or formal audit process. Tax avoidance is the legal practice of minimizing tax obligations. Tax evasion is the illegal practice of fraudulently presenting information used in calculating tax obligations. Tax avoidance strategies can involve the timing of incomes and or expenses to take advantage of changing tax circumstances. Learning objectives. Trace the tax effects of life stages and life changes. Identify goals and strategies that provide tax advantages. Identify tax advantages that may be useful in pursuing your goals, and discuss the relationship of tax consideration to financial planning. Um, Justice Chief Oliver Wendell Holmes Jr., um, who was on the Supreme Court 1902 through 1932, so 30 years, they serve a really long term, in my opinion, states taxes are what we pay for a civilized society. And of course, he would say that because taxes paid his salary. But, okay. So, um, sources of income through young adulthood are wages. Middle adulthood are wages and investments. And then older adulthoods are wages and investments. So, you remember an earlier chapter, we kind of had a similar, I think it was chapter 1, we had a similar slide where it shows you as you get older how your income is going to look through young adult, middle adult, and older adulthood. And then in retirement, you got investment. Your asset base, young adulthood is none, middle adulthood is accumulating, and older adulthood is growing, and retirement is depleting. Adjusted gross income is low in young adulthood, in your middle adulthood is highest in older adulthood, and then in retirement, you get lower. Depends. I would put here, it depends. So I put I here, ID, because if you have certain investments that pay out after your retirement, I mean, you may even make more money here during your retirement than at your young adulthood or middle adulthood phase. Your deductions and exemptions are low in young adulthood, so there's credits for that. Middle adulthood are higher, young adulthood are high, and then after retirement are low. Where you have a choice, it makes sense to use a strategy that will allow you to make progress towards your goal and realize the tax advantage. Your enthusiasm for the tax advantage should not define your goals, however. Taxes affect the value of your alternative, so recognizing tax implications should inform your choices without defining your goals. Your financial plan should reflect your vision for your life, what you want to have, how you want to get it, how you want to protect it. You will want to be aware of tax advantages or disadvantages, but tax consequences should not drive your vision. Benjamin Franklin said, "Friends and neighbors complained that taxes are indeed very heavy, and if those laid on by the government were the only ones we had to pay, we might the more easily discharge them. But we have many others, and much more grievous to some of us. We are taxed twice as much by our idleness, 3 times as much by our pride, and 4 times as much by our folly." Key takeaways of this section are that tax strategies may change as life changes and family structure change. Some personal finance goals may be pursued in a more or less tax advantaged way, so you should evaluate the tax effects on your alternatives. Tax strategies are the means to an end, that is, to achieve your personal finance goals with a minimum of cost. And this concludes Chapter 6, Taxes and Planning, of the Personal Finance text by Rachel Siegel. If you have any questions regarding this chapter, please feel free to contact me at any point at my Broward College email address. And thank you and have a great day.